Namaskar. A warm welcome to all of you. Myself, CA Vivek Khurana, and I hope you are doing well. And today we are going to discuss on a very important topic. I know I got many calls, sir, for international taxation, where to study, how to study, and now for that we have with us to discuss on sources and approach for self-study of international taxation. We have with us our guest speaker, very respected, very learned, CA Gaurav Singhal ji. Sir, a warm welcome to you.
Thank you so much, sir. Thank you so much.
I know you are very busy, but thank you very much for sparing time with us. And I just want to share with you, we are doing this for PM Care Funds and members are contributing. And really, thank you very much, everyone. Love you all. And now over to Gaurav ji, please.
Thank you so much. Thank you. All the listeners, warm welcome to all of you. And I think it's a very different kind of a setup. First of all, thanks Vivek ji. आपने जो setup किया है, particularly the mechanism you have created for getting contributions from all over the country for PM Care Fund. That's something that I really respect. And I think it shows that our community is really very interested as a national community and not just as a professional community, if I could draw that distinction between the two. Right. Is my screen right now visible to everybody?
Yes, but few slides are there. You can choose your slide. Yes.
Okay.
Now it's perfect.
Perfect. So today's session is a very interesting session. Typically what happens is that we come across sessions which are on topics which talk about a particular field of international taxation, and one is talking about that particular field of international taxation. But today what we are doing is doing something different. Instead of giving a fish, we are now discussing about how to start fishing on our own. Because that is what is going to make you self-reliant. That is what is going to make you saksham. So today what we'll discuss is, why do we want to do this? Why do we want to have a sense of self-reliance as regards study of international taxation? Then we'll talk about what are those particular aspects that we should be aware of when we are doing a self-study of international taxation. Therefore, instead of telling you definitions of permanent establishment, taxing provisions of royalty, fees for technical services, dependent purpose person services, capital gain, etc., let's talk more about what are those provisions which we should read. And then after we giving you a small introduction of those provisions, I would encourage you to go ahead and do it. And there again, there'll be a little bit of hand holding here, where I will try and share with you what at least is my thought process, that what are the fundamental provisions and what are the provisions which are useful to us on a day-to-day basis. How do we update ourselves as regards those fundamentals which happened probably 50 years back, 100 years back, and are still relevant? How do we keep ourselves updated about what are the developments which are happening now? So this will be the general approach of today's session. I will share with you the sources which are authoritative, share with you the sources which are not necessarily authoritative, but they're good guidances, and how you can stay updated in an easy manner, subject to, of course, the most important rule for achieving anything in life, the discipline. First of all, objective of this is plainly speaking, and I sort of indicated towards that, saying that give a man a fish and you feed him for a day, but tell him how to fish, tell him how to catch a fish, and you feed him for the lifetime. You make that person self-reliant for the lifetime. अब ये जो शब्द है सर, self, ये बड़ा interesting word है. इंडिया में अगर आप देखेंगे, everybody is, and India नहीं, globally everybody is focused a lot upon self. बट जैसे आप सेल्फ के साथ में स्टडी जोड़ देते हैं, एक तो स्टडी वैसे ही थोड़ा सरदर्दी का सौदा है, और उसमें भी सेल्फ स्टडी, नाउ दैट बिकम्स अ बिट ऑफ ड्रैग. But the problem is, there used to be a time when we had teachers, in our school, in our college, even when we were studying for our chartered accountancy examination. I remember the time when I had those fantastic, luminaries, those people who were gods of their respective subjects. JB Gupta sir, Vinod Gupta sir. These are people to whom we owe our entire professional career. But the problem is that is also now a thing of past. We don't have that many good those kinds of teachers with us now. And also now that we are chartered accountants, a lot of time we don't get the time to actually go out and study from people who are excellent people, who are ready to contribute, ready to share. But the time is a bit short. Lastly, uh, it's easy, we all think those were the days. या जैसे बहुत शौक से मेरे पापा मुझे कहा करते, पापा पापा कहते थे, बड़े मजे में रहते थे, पापा पापा कहलाने लगे, सारे मजे जाने लगे. So now that we are all at a particular age strata where we have to start developing the self-reliance, it's important that we also learn how to go about developing the self-reliance. So it's an oxymoron, but still. So today's session is actually not targeted towards people who are already good at, who are already working very well in the field of international taxation. No, it's actually meant for those people who are tax professionals, tax practitioners, finance professionals, whether in industry or in practice, tax officers maybe, but those ones who wish to be self-reliant. And therefore, a lot of professionals who are already practicing extensively on this thing, you'll probably find it a bit boring. But the ones who really are interested in developing that skill of self-reliance, this session is what is meant for you. Firstly, what is international taxation? There's no definition of international taxation. In fact, even as a concept, I think the right way to put it is how do you tax international transactions which are cross-border transactions? And there again, when we are talking about taxation, which taxation are we talking about? Are we talking about taxation in India or taxation in the other country? Well, I would love to talk about both. And often we end up giving advices on taxation in India, and along with it, some knowledge and information about taxation in countries outside India. But the fact is, as chartered accountants of India, as company secretaries of India, as lawyers of India, we people are really not authorized, strictly speaking, to advise upon laws of countries outside India. We cannot be considered to be subject matter expert generally in this case. But what is more important is when your client, when your employer will come to you, he will be seeking your advice on what will be the tax implication in India of a transaction which is taking place perhaps with a person sitting outside India. It could be a foreign company, it could be an individual, it could be an LLP, LLC, but what will be the tax implication in India of that transaction? And when we are talking about self-study, then what is the curriculum for the self-study? What is the curriculum for this international taxation? We have to start with domestic law. Now, this is strange. We are talking about international taxation and we have to start with domestic law. Well, that is where the foundation lies. The taxing provisions are there actually only in one law, which is the Income Tax Act in 1961. Therefore, taxation can happen only in the domestic law, but it happens in conjunction with double taxation avoidance agreement, with multilateral instrument. Therefore, we'll also talk about double taxation avoidance agreements and multilateral instrument. I will not touch upon transfer pricing for the reason that you have an excellent professional, Pallavi, who will be talking about transfer pricing with you tomorrow. Amazing professional, amazing author. She has a book that's practically a ready reference for me. That's how beautiful that book is. So moving to what are the basic provisions in domestic law that anybody who wants to self-study, who wants to achieve a level of expertise in international taxation, what are those provisions in the domestic law that we should be very much aware about? We should be again probably revisiting them. But the reason I'm calling this revisiting is because these are sections which are there at the very beginning of the income tax law. Single digit के section है साहब. So typically हमने section शायद BCom में भी पढ़े होंगे. हमने ये CA इंटर में, आई मीन मेरे टाइम पे इंटर हुआ करता था, उसके बाद शायद PE आ गया था और अभी एक चीज और आई हुई है. सो हमने इन प्रोविजंस को इतनी बार पढ़ लिया कि हमें लगता है नहीं इस पे तो हम पक्का से हमारी ग्रास्प पक्का होगी, कोई डाउट नहीं है. बट आई एश्योर यू सर, some of these provisions are such on which some of the most senior authors have written commentaries on one single section. They have written commentaries. So these provisions are such which were subject matter of a lot of litigation, debate, confusion, even at the time of independence, even when I was born, and even now that I have a daughter of my own. And we are still confused all the time about these provisions because these provisions keep on evolving. The interpretation of these provisions keep on evolving. Section 6, for instance, how do you determine the residential status? As late as this very budget 2020, had amendments on how do you determine residential status. So of course, when you are dealing with international transaction, when you are dealing with taxation of a person who's non-resident, the first question is who is non-resident, and therefore we'll have to focus upon the definition of who's non-resident. And mind you, often there can be scenario where a person might qualify as a resident in my country, but he may also qualify as a resident in another country, in which case some of the treaties allow for something called a tiebreaker test. Some countries say no tiebreaker test. अगर दोनों देशों के अंदर आप रेजिडेंट की तरीके से क्वालिफाई हो रहे हैं, if you're qualifying as resident in both the countries, then the treaty won't apply. And these are some of the important treaties that I'm talking about. Look at the US treaty, for instance. And recently, the tiebreaker test has also undergone a change because of the multilateral instrument, something that I'll be touching upon in a few slides from now, and something which has completely changed the landscape of international taxation. Once we have determined the residential status, then the next question is fine, but then how do you tax a non-resident? Or if you are a not ordinarily resident, then how do you tax a not ordinarily resident person? And that is something which is contained in section 5 subsection 2 and provision 5 subsection 1, taxation of non-residents and taxation of not ordinarily resident people. So the thumb rule for taxation of non-resident is, and you'll probably deal more with non-resident in day-to-day course. Not ordinarily resident is something which we don't ordinarily deal with. Taxation thumb rule for taxation of non-resident is that income which is received in India, that is taxable, and the income which accrues or arises in India, that's taxable in the hands of that non-resident in India. And so that there's no debate about some of the items for which the government didn't want any debate. It has a deeming fiction also. That is, some incomes are deemed to accrue or arise in India. Now, I told you at the beginning that incomes which are received in India are taxable on a receipt basis. Now that's something which is contained in the domestic law, right? But that is a principle which is mostly missing from the double taxation avoidance agreement. Therefore, if there's an income which does not accrue or rise in India but has been received in India, then will it be taxable in India? Well, prima facie, it looks like that will be taxable under the domestic law. Although, mind you, there are some domestic law related decisions which have deviated from this position, but I'm not getting into those details right now. But at least under the treaty, one thing is very clear. There's nothing called receipt basis at all. If an income is taxable in a treaty, generally, in India because of a treaty, then generally it is because of a distribution of taxing right on accrual principle, and hardly ever on a receipt principle. Section 9 is a section that I was talking about that gives the deeming scenarios in which any particular income accrues or arises in India. And this section 9 is something which has undergone a ton of changes, even in recent past. And this is something which will keep on evolving, because the thumb rule, the basic tests of when an income accrues or arises in India are also undergoing change. Look at an example, for instance. We had this concept of a physical place of business in India for a foreign company, for a non-resident, as a precondition for taxing that person's business profits in India. Traditionally, ये माना जाता था that if somebody is earning business profits in my local country, then if he's earning with a very fleeting presence, sporadic presence, then let's not tax it. But if that presence in India is something more wholesome, something more a nexus which is something more permanent in nature, then let's tax that person. But that connection, that nexus, usually was something in a physical form. Why? Because the businesses were conducted in physical form. But the fact of the matter today is that most of the businesses are not carried out in physical form. A lot of them are actually carried on purely electronically, purely digitally. Today, when all of us are sitting in lockdown, most of our groceries, a lot of daily use needs, essentials, necessities are being delivered to us thanks to these online businesses. So the thumb rule, the test of physical presence, is something which requires a reconsideration, because of which world over this question cropped up, that how do we tax them? Because of which even India, it has now introduced the concept that how do we tax businesses which may not have a physical presence, a substantial physical presence in India, but they may still have a significant economic presence in India. And that all is something which is coming as a part of Section 9. Similarly, the Vodafone controversy, the indirect transfer controversy. Again, the controversy was, how do you tax the capital gain in India when the shares which are being sold are not that of an Indian company anyway. They are of a foreign company. So the buyer is a foreign person, the seller is a non-resident person, the company of which the shares are being sold is also not resident in India. All that is located in India is the control and management which is getting transferred, control and management of an Indian company which is getting transferred by virtue of the indirect holding of this Indian company by a company outside India. How do you tax it? And again, that was also something which was incorporated by Section 9. So Section 9 is an ever-evolving section, because the way transactions will be structured, that same way tax laws will also keep on evolving. Saab ye chor police ka khel. So what is this Section 9 that I'm talking about? Let's have a quick look at it. Section 9, subsection 1, the most expansive part of Section 9, is the one which deals with taxation of business profits. And the precondition it lays down is business connection, something which was undefined for a long stretch of time. And even now that it is defined, it only has an inclusive definition, which is what is something called as an agency PE. And now it has also been extended by this concept of significant economic presence. So point number one, if you are planning to undertake a self-study of international taxation, then if you do not study Section 9 and particularly Section 911, you are making a huge mistake. Why? Because you may be examining a transaction, you may be feeling very comfortable that this transaction probably does not qualify as a fees for technical services in India, and therefore I don't have to worry about its taxation in India. But if we miss the part that what if that income, whatever be its characterization, is effectively connected to a business connection of that foreign enterprise which is located in India, then how do you avoid its taxation in India? Very difficult. And therefore, business connection is the first thing. Section 911 is the first thing that you have got to study. It has taken a lot of undergone a lot of changes. Those changes are something which are very clearly explained in the respective memorandums explaining the provisions of the finance bill, and perhaps we can discuss them in another session, because this session will permit us only to introduce you to the concept of business connection. Not just business connection, Section 911 also talks about capital gains. So therefore, if any asset is situated in India, a capital asset is situated in India, and when that capital asset is transferred, then the transferor may be a non-resident, and yet he'll have to pay tax on that capital gain in India. But that capital asset may not be directly situated in India. It may also include the scenario of an indirect offshore indirect transfer, the Vodafone kind of a situation that I referred to a while ago. Section 912, it talks about taxation of salary earned by a non-resident, and taxation of salary simply focuses upon whether a person who earned that salary was located in India or not for that duration of time for which he's paid that salary. Now, mind you, this is interesting. The person may be sitting in India, he may be providing services to his employer, and those services may have nothing to do with any Indian business. He may just be traveling to India, right? He may just be traveling to India without going on a vacation, giving a guarantee to his boss, I'm traveling to India, but don't worry, I'll be available online. I'll probably be available through GoToMeeting, and I'll keep on giving my response to you probably through email. So I'll keep on working. If that person is present in India for that particular duration, the fact that his services have nothing to do with that employer's Indian business, the employer may not even have an Indian business, yet Section 912 simply says that we will take into account the physical location, the physical duration for which the person who has earned the salary was present in India. And if that physical duration does not meet an exemption, which I'll touch upon in a little while from now, Section 10(6) clause 6, then so be it, we'll tax it in India. Again, what we see is a very clear indication that even today in 2020, our tax laws are focusing heavily upon the age-old concept of the physical location. They have not taken into account the possibility that the person who's probably sitting in India and rendering some services, employment services, may actually not be benefiting his employer, not be giving any gainful to his employer about India, but because he's using the Indian infrastructure, perhaps that's the reason why Indian government feels that it has a taxing right over that salary income. The next interesting or important part for us is to look at Section 915, 916, and 917. Now, why I'm saying 915, 6, 7 in one single breath? Because of three reasons. Because all three of them are taxed on the basis of the same tests. They are taxed on a gross basis, and they have similar taxing provisions. So to some extent, similar taxing provisions within the treaty. Now, let's look at what are the principles that I'm talking about. 9 and 5 talked about taxation of interest earned by a non-resident. That non-resident has given a loan to maybe somebody in India. Royalties are, again, 916 also talks about taxation of royalties earned by a non-resident. The non-resident may have given an intellectual property right, such as a patent, such as a copyright, such as a trademark. That right to use that IP must have been given to somebody in India. Fees for technical services, 917. This is also something which is taxed in the hands of a non-resident person or foreign company who has given that service to somebody in India. Now, what do I mean by somebody in India? Who's this somebody? If the somebody is an Indian government, as simple as that. If the somebody is Indian government, then no questions asked. Directly, the interest, the royalty, or the fees for technical services will be deemed to accrue or rise in India and will be taxable in India. If that somebody is an Indian resident, then again, I think it's natural to believe that if the resident is paying for this interest, paying for this royalty, paying for this FTS, then perhaps he's using it for his Indian business. If he's using it for an Indian business, then this income will be deemed to accrue or rise in India if it can be proved that no, while the resident was making these payments, he was using this entirely for a foreign business. Then these provisions say, okay, fine, let's not tax it. Let's not tax it under the domestic law itself. If it's a non-resident, now when I said he's probably giving it to somebody Indian, how would a non-resident be Indian? A non-resident having an Indian business, a non-resident having an Indian business. Imagine a foreign company having an Indian branch. If that Indian branch is making payment for that fees for technical services, then although the payer is a non-resident, but because it's a foreign branch, the Indian business which is making payment for this fees for technical services, it will still be deemed to accrue or rise in India. So this is the common thread, commonality between interest, royalty, and FTS under the domestic law. Even in the treaty, there's a lot of commonality between interest, royalty, and FTS. For instance, while in the domestic law there's a gross basis taxation for interest, royalty, FTS. What do I mean by gross basis taxation? No expenses are deductible. Just take the gross number, the gross amount of payment made, and apply it by a tax rate which is given in the respective provision. For instance, in the case of interest, royalty, and FTS, mostly the rate is given in 115A. Similarly, even in the treaty, the taxing principle is that if that income is accruing or arising in India, well, it uses the word arising in India, and if the recipient is the beneficial owner for these things, something that we'll touch upon in a little while, then again, India gets a limited taxing right, again on a gross basis. That is, the tax in India should not exceed a particular prescribed percentage, and that percentage is prescribed in each of the treaties separately. So this is the commonality between interest, royalty, and FTS. And the reason why again I've highlighted interest, royalty, and FTS is because on a day-to-day basis, when you start picking up work on international taxation, what you would find is a lot of payments for which you are being asked to advise upon will be something which will be probably taxable as fees for technical services, probably taxable as royalties. If your client is heavily into ECBs, external commercial borrowings, then probably it will be interest. So these are again transactions which are pretty much recurring in nature, and you'll find a lot of practical work coming to you from the interpretation of these very provisions. There are some special provisions again in the domestic law which talk about taxation of payments made to non-resident. 115A is something that I've already touched upon, that when any royalty, FTS, or interest, including ECB interest, the one which has lower rates of tax under Section 194, LC, LD, etc. For instance, now it has come down to even 4% when we are talking about bonds which are listed in IFCI exchanges, and we have 2 IFCI exchanges in India. Then the tax rate is a flat tax rate which is given in 115A. It is 20% in some cases, 10% in some cases, 5 and even 4% in a few cases. So this is a gross basis taxation. But all this time, the fundamental understanding is that this royalty, this FTS, is not effectively connected to an Indian presence, an Indian business connection, an Indian permanent establishment of the non-resident. Because if the non-resident, if the foreign company has an Indian presence, say an Indian branch, and the Indian branch is the one with which this royalty, this FTS, this interest is effectively connected, then is it not the business profit of the Indian branch anyway? And then let's tax the profit like we are supposed to tax profit. That is by deducting expenses from the incomes earned by this branch, by this permanent establishment, by this business connection. And then instead of applying a low tax rate of say 10% or 20%, apply the tax rate which naturally applies to it. For instance, if it's a foreign company, apply the tax rate of 40%. There are some provisions for presumptive taxation of certain specific kinds of businesses. Practically, unless you are very active in that kind of business, unless sort of your clients are coming from that background, they are into oil field services, they are into aviation, they are into civil construction for turnkey power projects, etc. You will not find these provisions really very relevant for you on a day-to-day basis. 44B, BBBB, and BBB. So I am not touching upon them for the time being. The next item also, chapter 12A, this is for NRIs, and therefore I'm not talking about these specifically, because when we are talking about international taxation, let's look beyond NRIs and look only at NRs, non-resident Indians, nahi, balki non-residents. While section 10 contains a lot of exemptions, well, some of them are also for non-residents. And a very good example for this is section 10.6.6, for instance, an exemption for people who are visiting India while they're in employment, earning salary income. If somebody visited India for only 7 days and he spent 7 days of his physical time in India, for which he has got paid a salary, are we saying that the Indian government will tax the income for those 7 days? If somebody has come down to India for only a couple of days, is Indian government expecting the person who's visited India for only a couple of days to file a return of income in India and pay tax on his proportionate salary for only those 2 days? The answer to that is something that you'll find in section 10.6.6, which is called short stay exemption. There's a concept of short stay exemption even in the treaty, and the two are somewhat similar but not identical. But go through section 10 subsection 6 clause 6 and you'll find the answer to the question that where a person has visited in India, where a foreign national perhaps has visited India for a shorter duration, and his salary is not being charged to any Indian business. There's no Indian permanent establishment which is bearing the deduction for that salary. That is, the Indian tax base is not getting eroded because of the expenditure on account of the salary. In that case, section 10.6 says, "Chal chhod diya, ja ji le apni zindagi, I will not tax you." And then section 90, well, if you are into international taxation, and section 90 is something that you have to look at. Why? Well, as I said, the domestic law is the only law which taxes anybody, whether a resident or a non-resident. But then what enables a double taxation avoidance agreement, a DTAA, or what we call the tax treaties, to be applicable to a non-resident in the first place is section 90, 90A, and 91. These are the sections which allow the Indian government to give a bilateral relief in case of 90 and 90A, or even a unilateral relief where there is no treaty with a particular country to a non-resident who is being subjected to double taxation. Now, why would there be a double taxation? Just imagine a scenario where even the non-resident is subject to a law which is nearly similar to us. In our law, we tax the global income of a resident in India and the Indian income of a non-resident in India. Now, in his home country also, he would perhaps be taxed in respect of his global income, including the Indian income, which means he's paying tax in the home country on Indian income because of the residential basis, and in India because of the territorial basis. Now, this double taxation is something from which section 90 allows double taxation avoidance agreements to give you a relief. And a lot of time that relief is in the form of foreign tax credit. Now, what do I mean by foreign tax credit? Now, let's reverse the scenario. Imagine your client is an Indian resident who has been taxed outside India because he earned certain income which accrued and arose outside India, and he has paid tax outside India. Now the poor guy is again taxed in India because, well, in India he gets taxed in respect of his global income, double taxation. In that case, what happens is, India being the mother country, the home country gives, the resident state gives a foreign tax credit. That means the tax which has been paid outside India will be treated against, will be allowed as a credit against the tax liability in respect of that income in India. So that tax which is required to be paid in India in respect of that same doubly taxed income, that tax will be offset against the tax which has been paid outside India. There's a computation mechanism, of course, which says that compute average rate of tax, whichever is lower, allow deduction for, allow credit for only for that, and that is the mechanism which is contained in Rule 128. Mind you, Rule 128 is a comparatively recent creation. There was absolutely no domestic law provision on how to compute foreign tax credit, and because it is a comparatively new creation, we see a lot of questions coming to us on how to compute foreign tax credit, which were not there so far. A lot of these questions remain unanswered. Why? Because Indian provisions for foreign tax credit, Rule 128, is not as descriptive as a lot of other countries have as regards foreign tax credit. So we see a lot of scope for evolution in Rule 128 itself. Another very important another chapter is GAR. Now, GAR is something which is a boogeyman, general anti-avoidance regulation. But now, general anti-avoidance regulation, they are contained in the domestic law. And Section 90 says domestic law or treaty, whichever is more beneficial, that will apply. In that case, any tax non-resident will simply say, sir, in treaty there is no concept of GAR, so we'll only opt for the treaty because under the domestic law there is a GAR and we don't want GAR to be applicable. Can you do that? And the answer to that is twice given in the domestic tax law, and the answer at both the places is no. That is, both Section 90 as well as Chapter 10A, they explicitly stated that the provisions of General Anti-avoidance Regulations, GAR, can overrule the treaties and therefore can deny you a treaty benefit. Therefore, if there's a particular arrangement which in the eyes of the revenue and the eyes of the judiciary qualifies as impermissible avoidance arrangement, that is what is the that's the expression that GAR chapter uses as an abusive arrangement. Then, in respect of that abusive arrangement, even if you want to take a treaty benefit, a treaty defense, a treaty exemption, Chapter 10 can deny that to you. And that's the reason why you have to, in the course of your self-study, include the provisions of GAR. Another thing, a lot of time there are a lot of provisions which we have studied with, but then we lose sight of them. Or sometimes we think, hey, these provisions can only be applicable on residents. They cannot be applicable on non-residents, because all this time we have thought about them, we have talked about them, we have applied them only in the context of resident clients. I learned that as a rude awakening in 2003 or 2004. I remember I was working on an EPC. That was the first time in my life I was working on an EPC contract. 2001 I had qualified. 2003 I was working on an international level EPC contract in which there was an offshore element, the onshore element, and the whole bells and whistles. And there was, of course, a foreign, a non-resident enterprise, and it had an Indian group entity. They had formed a consortium, and the consortium was doing the entire contract together. And I analyzed the entire contract in bits and pieces, but I completely missed that as a consortium, do they create what we call an association of persons? Now, when my senior, he pointed that out to me, that Gaurav, you have not at all examined the concept of association of person. I was taken aback, because all this time when we had talked about association of person, whether I was in BCom honors or as a part of the CA Foundation Intro Final, we had always thought of them in the context, or at least I had always thought of them in the context of an association of persons in India. I had never even applied my mind to the extent of breaking those barriers in my mind, that an AOP as a concept is silent about whether those persons have to be resident or non-resident. Therefore, an AOP can come into existence where one person is resident and another is a non-resident. And then when I thought deeper into it, I realized we had even probably studied about it at a place, but completely missed it. In practical application, I completely missed it. So the point that I'm trying to drive home here is that often we might be very comfortable applying a particular provision only to our resident clients, and we may completely overlook the possibility of its application to even our foreign clients, even to foreign companies. Another good example for this is application of MAT. There was a controversy, now this is this is older than 2009 now, but there was actually, a legal controversy on whether minimum alternate tax provisions 115 JB can they not apply to foreign companies, given that they are not even required to maintain books of accounts under Schedule 6. Back then it was Schedule 6 of Companies Act 1956, which formed the very basis of computing the MAT. A lot of people held divergent views about it. There were decisions, etc., and then there was an amendment which was incorporated in 115 JB that only in some cases MAT can still apply. But before that, the answer was nobody knew that, nobody had thought about it, and now the answer to that is MAT can apply in those cases even today, in spite of the fact that the company is a foreign company. So that was about the domestic tax law provisions, which are relevant if you are studying if you're self-studying about international taxation. I will now take you through the double taxation avoidance agreements, how they're formed. And while obviously a double taxation avoidance agreement runs into more than 23, 25, more than 30 articles, and I am not planning to take you through each of them, I will highlight to you that which are the ones which you should prioritize in your self-study. Because otherwise, if you'll start applying all of it yourself from the days from scratch, it will take a lot of time and you'll probably run out of breath. So let me highlight to you the ones which are most relevant for you from a self-study perspective. Firstly, I have already touched upon it that section 90 is a section through which you can apply a treaty. But which treaty? Are you even validly applying a particular treaty in the case? I'll give you an example. There was a particular scenario in which we came across where an Indian person, where our Indian client was making a payment to an Italian company. And it was very confident, therefore, that the Indian-Italy treaty will apply. But interestingly, what was happening was that the payment to the Italian entity was being made at the request of, at the instruction of the UK entity, which had actually entered into the contract with our Indian client. So really speaking, the entity which had provided the service was the UK entity. The entity which was entitled to that remuneration was a UK entity. And it's just that the UK entity had instructed our Indian client to make the payment to the Italian entity. And our client was happily applying the Italian treaty to it. Well, the Italian treaty had no application to that because the payment was being made on behalf of the on behalf of the UK recipient. Therefore, it was only the UK treaty that could have applied. And this question is something which confuses a lot of bankers even today. Another example, for instance, now imagine a scenario where the UK entity has an Italian branch. Now, this time again, you are making a payment to the Italian branch, but is the Italian branch resident, a tax resident of Italy? The answer to that is we don't treat branches. India does not treat branches as tax resident of a country separate from its home country. Therefore, to us, the Italian branch is a tax resident of the UK head office country, and therefore still the UK treaty will apply. And again, you'll see in a lot of situations where Italian treaty is wrongly applied. So first of all, you have to identify of which country is the recipient to which you are applying, or the person to which you are applying a treaty. Of what country is that person a resident of? If that person is not a resident of a particular country, then India's treaty with that country will not apply. Also, then you have to check that is that treaty even in force or not. India is now is blazing through a lot of new treaties, or revising a lot of treaties which were already there in past. Now, would the new treaty apply immediately upon its signing? Not necessarily. It depends upon when it has been notified. Or a treaty which has just been signed today, it has not been amended, it has not been revised. Will it be applicable with the date with which it has revised? I'll give you an example. Hong Kong Treaty, when it was signed with India, it made a lot of news. And about a month or a couple of months after that, we started seeing questions that can we apply the Hong Kong Treaty with India in say a month's time. But again, you have to check the entry into force provisions. If you are very reasonably confident that this is the old treaty that you're looking at, it has not undergone any amendment, any revision very recently, then fine, don't worry about entry into force. More often than not, you will find that that's perhaps not something that you should bother about. But otherwise, if you think it's either a new treaty or a treaty which has undergone a recent change and you are applying that recent clause in your interpretation, then please check whether or not it has come into force or not. Another thing that you have to look at is that a lot of treaties have something called a limitation of benefit clause. That is, that it may appear to you that the residence test has been met, and yet you may realize as a rude shock that that is not the only test. Let me give you an example. Again, let's look at the example of India-Mauritius Treaty. A client of yours tells you that my Mauritian shareholder has sold the shares of the Indian company, and the Mauritian shareholder is planning to take certain benefit, which was there in 2019 for that sale of shares. Can it do so or not? And you might think that, well, let me look at the treaty. Well, the Mauritian shareholder is clearly a shareholder in Mauritius, and therefore the treaty should apply to it. But that's where you'll stop, and you'll probably have to check that is there a clause which is named as limitation of benefit clause under the Mauritian treaty, because if you search for it, you will find that for applying capital gain related certain benefits which are given in the Mauritian treaty, you cannot just apply it merely because your shareholder is a Mauritian resident. It will have to satisfy a few more tests, and then and only then will it be able to apply the benefit contained in the Indian Mauritius treaty. Now, one of the tests, for instance, is that it should not be a shell entity, and one of the clauses which is given in the Mauritius treaty is that if that entity is spending more than 27 lakh rupees, Indian rupees equivalent in Mauritius on operations, then it will not be deemed to be a shell entity. So that's the kind of language which is written there. But the point that I'm trying to make it is that merely because it's resident in Mauritius does not necessarily mean that it's not a shell company resident in Mauritius. And Mauritius treaty contains a limitation of benefit clause, and similar clauses are present in a lot of treaties in respect of certain specific kinds of income. So they may not apply when you are applying the said treaty to another kind of income, dividend for instance, but they would apply when you are trying to apply the same treaty but in respect of the particular kind of income to which the LOB clause applies. Beneficial ownership. Again, this is a clause which you'll find. Remember, I told you at the beginning that there are a lot of commonalities between interest, royalty, and FTS. This is also one of those commonalities. The treaties, most of the double taxation avoidance agreements, they allow the source country to have a limited taxation, right? Source country where the income is sourced, where the income is arising. In my example, for instance, if a royalty is being paid by an Indian resident to a non-resident, then the source country is India because the royalty is arising in India. So most of the treaties allow the source country, India, to tax it, and then they give a benefit to the non-resident. What is the benefit? The benefit is these treaties mostly say that the tax in India cannot exceed a particular prescribed rate given in the treaty. In some of the treaties, that prescribed rate is say 10%, right? If you look at taxation of dividend, in some of the treaties, the tax rate is 7.5%. You'll actually come across rates as low as 5% in a few of the treaties. But when the domestic law says 20% for dividend, and and the treaty says 7.5% or 5%, everybody would be tempted to say, fine, in that case, let's open a shell company in the particular country which gives that 5% tax rate, which gives that 7.5% ceiling. Therefore, it will override the Indian domestic law, and therefore the dividend cannot be taxed at 20%, but it can only be taxed at the lower rate given in the treaty. Is that true? Well, not necessarily so. Why? Because if you look at the fine prints in the said clause, what it says is that the said lower rate will apply if and only if the company so receiving the royalty, so receiving the dividend, so receiving the FTS is a beneficial owner of that income, which in most of the trading shopping scenario is not the case. So again, you have to probably not just study the concept of beneficial ownership. That is, what do you mean by beneficial owner? But when you're actually applying it in real context, you have to either ask your client that is the entity which is earning this particular income outside India, is it the beneficial owner or not? And if the client is not ready to give a straightforward answer to that, then at least state it as a caveat very clearly that this is a question to which you don't have an answer, and you're only proceeding on an assumption that the entity which is receiving it, the entity to which you're applying this treaty, is eligible to gain this benefit because it is a beneficial owner, because a client has not given me any information to the contrary.
Gaurav, one query is there.
Please, sir.
Is Hong Kong treaty came into force now?
It is now.
Okay, thank you.
Yeah. So now we are moving on to another very interesting area. Now I'll introduce you to the concept of multilateral instrument. Multilateral, bilateral, unilateral, and now we have something called multilateral. Bilateral, between two parties. Unilateral, only acting singularly. multilateral between multiple parties. एक, अनेक. A multilateral instrument is a creation because of the OECD G20's BEPS initiative, base erosion and profit shifting initiative. OECD group of companies and a lot of other non-OECD members, G20s, etc., they were all constantly complaining that a lot of tax avoidance tactics are going on, because of which their country's tax base is getting eroded. Base erosion of tax base is happening. A lot of maybe multinational group having some presence in the local jurisdiction, they are shifting profits out of their jurisdiction to other low tax jurisdiction, other no tax jurisdiction, so that no tax is required to be paid in the home country. So a lot of base erosion and profit shifting was happening, which was abbreviated as BEPS, base erosion and profit shifting. OECD said, look, you guys seem to be very serious about it, so why don't we do something about it? And it came up with 15 action plans, 15 action items, basis which it will try to address this issue of base erosion and profit shifting. And the last action item was action item 15, was multilateral instrument. What was the idea of multilateral instrument? After a lot of studies, after a lot of work done by various committees, it was clear that two changes are perhaps required: a lot of changes in the domestic law and a lot of changes in the treaties. Now, changes to the domestic law are something which are left to the countries. You'll have to work it out yourself. If you are so desperate that a lot of people are stealing taxes away from you, why don't you make changes in the domestic law? Go ahead and do that. Every country is doing it. India is doing it. Significant economic presence, equalization levy in 2016, equalization levy in 2020 budget. All these are examples of our domestic law changes. But that is not sufficient, because a treaty can overrule the domestic law. Therefore, treaties are to be amended as well. The problem is that treaty amendments, treaty revision takes a lot of time. The classical example that we give all the time is India-US treaty took more than 20 years to be negotiated. Now imagine if somebody starts negotiating treaties today, it will take so much time. And again, if each of the treaties separately renegotiated to counter the BEPS efforts, to plug the loopholes, then each of the treaty will evolve into separate kinds of amended agreements, which means one agreement would be different from another. Again, there will be a possibility of treaty shopping. One will be more beneficial, one will be less beneficial. Everybody would probably try to go towards the more beneficial treaties using the treaty shopping devices we have already seen. Some degree of global standardization was required, and that's where OECD said, Thamba, let me do. And with the cooperation of more than 100 countries, India being one of the front runners in this, it developed a multilateral instrument. It said, I am drafting the multilateral instrument, and now the countries have to come forward and sign it. Because once you will sign it, what will happen is, then the multilateral instrument will now act somewhat like an amendment to the double taxation avoidance agreement. Let me give you an example. For instance, if India says that in my treaty with Singapore, in my treaty with Mauritius, I'm ready to bring some changes which are already written in the multilateral instrument, which I participated in development of. I'm happy about those changes. Then the Indian Mauritius treaty or Indian US treaty or Indian Singapore treaty will not immediately get impacted. No, it would mean that the other party also has to agree for it. In case of Singapore, Singapore has agreed that Indian Singapore treaty should be affected by MLR. Now, when that happens, the India-Singapore treaty becomes a covered tax agreement, CTA. Between India and Mauritius, India has agreed to it. Mauritius has not agreed to it specifically vis-a-vis India, because of which India-Mauritius treaty is not affected, and therefore it is not a covered tax agreement. US is a fantastic country, you know that, right? And US has said, to hell with all of you, we are not agreeing to multilateral instrument with any of you. And therefore, US treaty with anybody, including India, is not a covered tax agreement. And we'll talk a bit more about MLI in a little while from now, but it's an extensive topic. I took 3 days session to our each on multilateral instrument last week, but it's that that's volume in it, voluminous. But the point that I'm trying to put across now is a very important clause of the multilateral instrument. Wherever any of the treaty that you are looking at, if that treaty is a CTA, then be on your guard for another very important clause, and that clause is called a PPT. PowerPoint? No, principal purpose test. Now, what is principal purpose test? Well, in a very laymanish sort of speaking, it is somewhat a bit like GAR. Just like GAR can overrule the treaty benefit, it can deny the treaty benefit. Principal purpose test can also do so, but that is the only way in which it's similar. Otherwise, principal purpose test is a lot easier test. Easier in the sense it can be easily violated. Even from the perspective of checks and balances which are given for application of GAR. For instance, you will have to first ask a CIT and then go to a GAR panel to take a permission to invoke GAR. PPT has no such checks and balances. PPT is a simple test which says that, look, if you are using a particular arrangement and one of the principal purposes, not the only principal purpose, which is by the way the test under GAR. Under PPT, if one of the principal purposes of that arrangement is to obtain a tax benefit under this particular treaty, the treaty that you are looking at, which is a CTA, which was not otherwise intended to be given, in that case, that benefit will be denied to you. There's only one exception, which is an object and purpose exception, but let's not get into those details for the timing. That's for self-study. But the point that I'm trying to make is that, just like I told you a little while back, that when you are planning to do a self-study for international taxation, don't overlook CAR, because they can completely negate a treaty benefit. So can a principal purpose test where the treaty is a CTA. How will you find out whether or not a treaty is a CTA? I'll come to that in a minute. What else? When you are looking at treaties, naturally the treaties are drafted in a language which is different from the language that we typically see in our domestic law. They commonly use expression contracting state and other contracting state, and in each of the clause, contracting state and other contracting state can have different meaning. So contracting state is basically a country. Really speaking, there are mostly two kinds of contracting states in any treaty that we are looking at. One treaty is a resident country. The resident country means a country of which the person whose taxability you're trying to judge right now is a resident of. For instance, a common situation can be where your Indian client is making a payment to an American, to a US service provider. There, you will probably proceed with the understanding that the American service provider is a resident of US, and in that case, America, US of A, is the resident state, whereas India is the source state. Resident state, source state, RS, SS. Now, in most of the clauses, the language is drafted in such a manner that where an enterprise of a state, which is the first contracting state, that is the resident state, and then it goes on to state, in such a situation, the other contracting state also has a right. Now, what do you mean by the other contracting state? If the contracting state was the resident state, then the other contracting state is the only other state that we're talking about, the source state. So I'm introducing this concept to you because a lot of time I've seen people worrying about, is there a standard meaning of the contracting state and other contracting state for all the clauses in a single treaty? And the answer to that is no. It will depend upon treaty to treaty. If you're looking at, for instance, capital gain clause, it's possible that in capital gain clause, you may realize that there has always been an offshore indirect transfer in the treaties, but only where the shares of the foreign company are deriving their value principally from an immovable property located in India. So there the language is perhaps going to have three countries involved. Country number one, the country where the seller of the shares is a resident. Country number two, the country where the company of which the shares are being sold is resident. Country number three, the country where the immovable property, because of which the value of the shares of this company is deriving its value, and that immovable property may be located in India. So you can have three treaties, and therefore don't think that there's going to be a standard meaning of contracting state and other contracting state. Look at the clause, and there you'll probably find that in this clause, the meaning of contracting state and other contracting state will only mean the resident state and the state where the immovable property is located, which becomes effectively the source state, and the state where the company is incorporated will probably not even be relevant for the determination of taxing of these capital gains. That essentially brings me to the most important question when you are looking at any international tax related query, and the question is that of, firstly, characterization. What kind of income are we talking about? Is this particular payment royalty? Is this FTS? Is this interest? Is it independent personal services? Is it other income if it doesn't qualify as anywhere? And if the answer to first question has been found out, then and only then you can move on to the next question, that where is it taxable? First, try to figure out the nature of the income and then apply the relevant article. When you're applying the article, uh, it's a common mistake that we look only at the particular article of the treaty, but don't just stop there. There's something more, something very important that you have to look at, and it's called a protocol, and I'll come to the protocol in a minute. So this is what a treaty, or at least the index of a treaty looks like. Treaty has what we call articles. It doesn't have section, it has articles. And it has usually in excess of 30 articles. I have listed here the ones which are relevant for you on a day-to-day basis. If you are getting a very specific kind of question, then other articles would naturally be applicable to you. If you're talking about taxation of sportsmen, taxation of entertainers, directors' remuneration, students, then a very specific kind of article will apply to you. But more often than not, what you will find is you are coming across questions which are about taxation of royalties, FTS, interest, dividend, taxation of business profits. These are the kinds of questions that you look at, and that's the reason why the articles which will be relevant to you will be articles 7, 5, 12, 11, 10, and whether or not the treaty is even applicable to you is something which will be answered by Article 1, which says that it is applicable only if the person is resident of at least one of the two countries that we are talking about. What are the definitions that we are looking at? They're contained in Article 2, just like Section 2 has the definition. Section 2 has the definition. We have Article 3, which has most of the definition. Residence is something which is determined as per Article 4. Permanent establishment, the big boogeyman, is defined in Article 5. And it has various kinds of permanent establishment, which is again non-standard amongst treaties. Some of them may have or may not have particular kinds of permanent establishment, such as service fee. The permanent establishments which are mostly common in all the treaties are fixed place fee, agency fee, construction fee. Article 13 is contained in capital gains, independent personal services. Now, this is a fancy way of saying professional income earned by individuals or professional income earned by firm of individuals. Mind you, in some of the treaty, the word individuals and firm is actually missing. So in some cases, it has actually been held in Indian courts that this clause can also be applied to professional income earned by persons who are neither individuals and nor firms. Therefore, even companies can enjoy this article. Dependent personal services again is a jargonish way of saying salaries. And the article which I find very dangerous is Article 21, other income. Other is something that we think other hai, sambhal lenge, but anything which is not taxable anywhere could still be taxed here, depending upon the characterization. If the income is not even characterizable under any of the preceding articles, it could still be taxed under Article 21. Article 23 is an article which talks about credit method or exemption method. In Indian treaties, you'll mostly find credit method. What credit I'm talking about? Foreign tax credit, Rule 128. I just told you about that. That's usually finding a reflection in Article 23, but a lot of treaties have foreign tax credit which is in excess or which is different from what's written in Article 128. For instance, it contains some unique kinds of foreign tax credit which are even missing from our domestic tax law. Tax sparing, underlying tax credit, etc. Now that's something you will come across in Article 23. And protocol. Protocol is the part that I was telling you about. That's something you don't have to miss. What is a protocol? तो साहब क्या होता है, देखिए जब हमारे लॉ में कोई अमेंडमेंट होती है, तो what we are accustomed to, what we are habitual of, is that we see that amendment incorporated in the act at the relevant place. For instance, if a particular amendment has happened in section 911, that 911 explanation 2, then the particular amendment will be incorporated in explanation 2 of 911. And therefore, our life is to that extent easy that we don't have to pin down every amendment to that particular clause. But I wish it was so simple in treaties. Whenever an amendment is made to a treaty, often the amended provision is not incorporated in the original provision. Instead, it is copy pasted at the bottom of the treaty, which means that if you are happily reading a particular article, imagine for instance, you have come across the taxation of, you have come across a question on taxation of fees for technical services under the French treaty, and you are looking at the definition of fees for technical services under the French treaty, you are reading what is contained in Article 12 of the French Treaty, and you see that the definition of fees for technical services is a standard definition that you are habitual of. Managerial, technical, or consultancy services, the same definition that you find even in the explanation to section 917. So you're confident that fine, I know the definition of FTS as per the classical managerial, technical, consultancy services one, and this definition, this particular service definitely satisfies this definition. So you are sure about the characterization that the particular payment is characterizable as FTS. Then if you do not go to the end of the treaty and search for whether or not there's a protocol, you may be ending into a soup. You may be making a mistake. You may be making a blunder. Why? Because when you actually scroll down, when you actually flip over to the end of the said treaty, you will find it contains a protocol. Protocol is that part which was amended, which was pasted at the end of the treaty rather than incorporating just the amended provision in the relevant clause, in the relevant article. And that protocol perhaps contains a provision which is far more superior, far more beneficial than the original clause of the treaty. For instance, again, let's carry on with the example of India-France Treaty. India-France Treaty protocol says that that definition of FTS which is written upstairs, that's fine, that's all good, but we are making it even better for you. And now what we are saying is that you can have a narrower definition of FTS in the India-France Treaty if India enters into such a narrower definition in any later subsequent double taxation or avoidance agreement with any other OECD country. In that case, you will start searching for whether or not India has any subsequently signed double taxation or avoidance agreements with any other OECD member country, and if that subsequently signed agreement has a narrower definition of FTS, and that is where you may come across something which is fondly called make available clause in the definition of FTS. And in that particular make available clause, which is a narrower definition of FTS, you may realize to your amazement that your particular FTS does not qualify. Therefore, it's not even taxable under the India-France Treaty. That means no tax is required to be paid in India on that particular FTS. Now, that is the reason why you have to look at protocol. Now, hold on. I will again sort of give some particular names to these clauses. Remember the clause that I was just telling you about, which is often contained in the protocol, which says that if India has entered into a subsequent treaty with a particular group of countries, say an OECD country, or with any country, then if that other treaty, that subsequent treaty contains a narrower clause, then that narrower clause will also apply to us. Now, this is called, in our jargon, most favored nation clause. Now, when you are looking for most favored nation clause in a treaty, there are three words. When you do a control F, right? You do control F and you type in those words to search for most favored nation treaty. There are three words that you type. If you type, you'll not find anything relevant, anything useful. Those three words are most favored nation. This is a jargon that we use. So most favored nation clause is worded a lot more differently, which basically says that if at any date after the signing of this agreement, India has signed another double taxation avoidance agreement with another contracting state in which a rate lower, a scope more restrictive than the existing one has been agreed upon, then the said lower rate or a said restrictive scope will also apply to the instant case. As you can see, we guys don't know how to make things simple, and that's why perhaps you and I are making a lot of money. But the point is, this is called a most favored nation clause, and it is seldom found in the original clause. It's mostly found in the protocol, and therefore you cannot ever overlook the protocol. Make available clause is something which okay, if you have to do self-study, why don't you start from there? Treaty, go to its protocol and see there, because its protocol contains not just an explanation but actually illustration. It has given example, company A, company B, fantastic thing, right? So it has given examples of when a particular payment qualifies this make available test and when it does not. And therefore sometimes protocol gave us amendments, and sometimes protocols gave us explanations. This second example is the one which is contained in India-US Treaty. We have already talked about MLI. Let's look at how MLI works by way of mechanics. I've given you an example here. A, B, and C. These three are countries. A, B, and C. These three are countries. When A tells to OECD, because OECD is a depository, right, for the purpose of MLI. So it contains the record of who's opting for what. So when A tells to OECD that, look, do I want to or do I not want to apply the CTA to do I want or do I not want the MLI to apply to my existing double taxation avoidance agreement, then it says that I will be happy to apply my double taxation avoidance agreement with country C, country D, country F, and country G, the first column here, right, to be amended by virtue of the MLI. Similarly, B notifies to OECD that B would be happy if its treaties with country A, country C, country G, and country F are amended by virtue of the MLI, and C similarly gives its own sets of recommendation. Now let's see how would it pan out between A, B, and C. Has A notified B in its list? It has notified C, it has notified D, it has notified F and G, it has not notified B. Mind you, B has notified A, but A has not notified B. It is a classical Karan Johar, Shah Rukh Khan, Kajol and Rani Mukherjee situation. One loves another, the other one doesn't give their access. And in this case, therefore, because in between A and B, A was happy to come ahead, but B was happy to go ahead and amend its treaty with B by virtue of the MLI. But since A backed off, its treaty, A-B treaty, will not be a CTA. Let's look at A and C now. A has notified C, yeah, and C has notified A, yes, and therefore A-C treaty, it does become a CTA. But now, mind you, please understand, I give you the example of Karan Johar movies, right? And in Karan Johar movie, it is possible that firstly, a couple of people, they fall in love with each other, but they say no to one another. But it's again very common that later on, one of them dies for whatever other reason. These two people who had said no to each other at a point of time, they still fall in love together, and that is also equally applicable in case of an MLI. That means it is possible that a future date A may say yes to C, and in that case, A and C, their treaty, A may also say yes to B, and in that case, A and B, their treaty will also become a CTA. So it depends upon how Rahul feels towards Anjali. So far, I have told you about some of the concepts which are the most fundamental introductory concepts to be able to navigate our way through the concept of through the application for the purpose of application of this vow that we have taken of self-study of international taxation. But I think it is also my duty to introduce to you what are the sources and what is, in my personal view, and that's my view, right, the approach that one should take if one is going ahead with the application of self-study of international taxation. 20 to 30 minutes, so I was granted a time of 1 hour 30 minutes, and I'll try to close it within that time. uh, Vivek ji, I hope that is okay. If you want me to stretch it, I'll be always more than happy. I'm talking about taxation, I can go on talking about taxation
No issue, no
for
issue,
longer
sir.
duration. Thank you so much. Thanks. So first of all, see, it's easy to say that I'll start reading something today and learn it all, but in our field of study, we are talking about a lot of time interpreting a sentence, a word, sometimes a comma, and there are case laws on the meaning of an absence of a comma, right? Secret process. Uh, so the real way in which I personally feel I get to learn is when I have actually got a particular issue to research about. Now, how would you get that issue to research about? Uh, you can probably form a group between yourselves where a single question which comes to you can be shared between you so that you can jointly undertake a research. Of course, take care of client confidentiality, take care that you don't share the facts which help anybody identify the client. But otherwise, the legal question can be shared so that you can jointly study about it and jointly benefit from a common from this group study. But once you have got a particular question, then you will find that the manner, perhaps the obsession with which you will look for answers, you will start reading, will be a lot more. Otherwise, I'm sure you are very disciplined people, but perhaps life will take over, and at some stage you might give up on your go of self-study. So if you are as semi-disciplined as I am, then I strongly recommend try to look for excuses to study about this field, and that is try to look for friends who would share with you just the questions, if not the fees. And that's perhaps the difference between profession and business, that in profession we don't have any competition, and that's the reason why we guys do what we call practice. That is, we keep practicing. Second thing, when you're studying, divide what you're studying into two parts. First part is what you may call the fundamental. It is already there, and there's a lot of fundamental. Your approach to studying the fundamentals has to be very different from your approach for studying of the developments. What I'm trying to say is there are so many fundamental. There's so much of fundamental that its content is voluminous. You can't take a vote that I will read it all in 7 days and retain it, understand it all, because let's be reasonable. It's too much to study. So for studying the fundamentals part, your approach has to be very different. That is, don't pick up multiple sources. Pick one source, or okay, maybe two at max. And what are those sources? I will move one slide after this one. We'll be talking only about sources. And then there again, don't study everything from cover to cover. So I know everything is important. I know that, right? But I still think that in order to retain your interest, you should study those topics which are meatier, those which are exciting, those for which you will get a lot of queries on a day-to-day basis. So typically, साहब क्या भी हुआ करता था जब भी, at least what happened in my case was when I was in 11th standard or 12th standard. So जो कॉमर्स की किताब का पहला चैप्टर होता था, oh my goodness, इकोनॉमिक्स की किताब का जो पहला चैप्टर होता था, that was a lovely chapter if you are trying to fall asleep and you are unable to. Similarly, what you'll find is that a lot of times the initial parts of fundamentals, for instance, article 1, 2, etc., are are a bit heavy in terms of being able to flow through them. Similarly, towards the end also, there are a lot of articles which you probably not be able to keep yourself awake through. So focus upon the ones which are most relevant from a day-to-day basis, and not apply too much of mind to it. Which are the ones that you already have heard about? Permanent establishment, the boogeyman, royalties, FTS, interest. Let's start with that, because at least you'll be asked a lot of questions. You will get a lot of questions. You will not get a lot of questions, sir, on taxation of directors' remuneration. Therefore, what's the point of trying to read through that and maybe become an expert on that without knowing anything about the stuff which is going to be more relevant to you on a day-to-day basis? So prioritize. If you want to actually have a broad coverage, end-to-end coverage, and you want to do it quickly, then perhaps we are not talking about self-study alone. You then probably need, well, go ahead and join an online course, and there are so many good online courses, including the one which is right now being run by Vivek ji. They are good online courses, and well, the only silver lining about the COVID thing is a lot of them are free now. So why don't you go ahead and join them? What are the sources for this fundamentals that I'm talking about? Well, the first fundamental is the treaty itself. And who are the ones who first came up with the draft treaty? Well, actually, it's neither OECD nor UN. We can probably go back as much as League of Nations if we want to go in relevant history and not beyond that. But OECD's draft, and draft को हम लोग अपनी jargon में क्या बोलते हैं? ड्राफ्ट को हम म्यूचुअल कन्वेंशन बोला करते हैं. कोई भी कंट्रीज अगर ट्रीटी साइन करने के लिए बैठती हैं तो उससे पहले नेगोशिएट करना पड़ता है, और ट्रीटी नेगोशिएट करने के लिए बैठती हैं तो जीरो से नेगोशिएट नहीं होती है. एक स्टैंडर्ड ड्राफ्ट हर एक कोई लेके चला करता है. यूजुअली डेवलप्ड कंट्रीज OECD ड्राफ्ट, डेवलपिंग कंट्रीज UN ड्राफ्ट, दैट इज OECD म्यूचुअल कन्वेंशन एंड UN म्यूचुअल कन्वेंशन को लेके बैठ जाती हैं, और दोनों ने अपने अपने कन्वेंशन के मीनिंग को अच्छे से डिस्क्राइब कर रखा है एक कमेंट्री में, जिसे OECD म्यूचुअल कन्वेंशन कमेंट्री एंड UN म्यूचुअल कन्वेंशन कमेंट्री कहा जाता है. OECD म्यूचुअल कन्वेंशन कमेंट्री is a larger one of them. It is also the one which is more extensive, which updates more regularly. A lot of research is being undertaken by OECD at a much faster pace, which is the reason why, although it is said, whether rightly or wrongly, that Indian treaties are based upon UN commentary, still you would find that OECD commentary gives you more relevant background on the meaning of the clause in the article. तो अगर आप कभी भी कोई treaty पढ़ रहे हैं, उसमें एक particular clause लिखा हुआ है, उस clause का interpretation क्या होना चाहिए? Article 5 साहब आपका एक पेज के अंदर अंदर खत्म हो जाएगा, लेकिन Article 5 की commentary 100 पेज में भी खत्म नहीं होगी अगर आप सिर्फ OECD commentary देखते हैं, right? So firstly, what is the source for studying the meaning and the treaties themselves? For studying the treaty, the most authentic source that you can find really is the Income Tax India's homepage, and the link on that which I've given here. And for reading the meaning of those clauses, you can go to the first link here, the OECD commentary. OECD commentary cannot generally be downloaded, but you can easily access it in a read online mode. MLI that I was talking about just now, and explanatory statement to MLI is also available on the OECD page, and the links are given here. If you want to read more about the BEPS action plan, the 15 action plan that I was telling you about, although quite frankly, I would suggest that slow down, don't be in such a rush. If you don't have a basic knowledge of the fundamental topics that I was telling you about a little while back, at least the important ones again, most importantly, permanent establishment, most importantly, treaty shopping, then don't directly jump on to BEPS action plans. But when you want to, this is the link that you can get. For MLI, there are more links which I've given here. And this is the Bible I was talking about. So when I mentioned try to stick to a single source when you're reading about it, this is a source which I personally, generally, mostly recommend. So this is the OECD Mutual Convention commentary that you can find online. It's not binding, and yet it's very authoritative. Why not binding? Because India is not an OECD member. Still, why so authoritative? Because it's such a good work. A lot of time you'll find Indian case laws referring to OECD commentaries, and while not be referring to that in a binding manner, and yet accepting what the OECD commentary has said. It's freely available. It's updated very fast, in the sense a lot of research is being undertaken by OECD, and therefore it keeps on incorporating those changes in the OECD commentary itself. If you want to have a hard book with yourself which contains the latest version, or at least the latest version at the time of the publishment of the book, then you'll find a good number of authors have written commentaries in 2 volumes. The first volume typically contains all the double taxation avoidance agreement, that is the text of the DTAs itself, and then the second volume contains commentary on each of the articles. So this take a volume each, and it contains relevant part of the OECD commentary. It also contains what are the Indian decisions, which is obviously not there in the OECD commentary, but the Indian decisions, Indian jurisprudence, maybe even circulars at times on the interpretation of those relevant articles. So this is more India centric. So frankly speaking, I can actually tell you that if you have to go to 2 sources, then this is probably where you can put an end to it. That's it. But I find so many times that people are telling me that, Gaurav, should I also download a UN commentary? Go ahead and do that. Here's UN commentary. Should I buy Klaus Vogel if you're feeling particularly rich on that day? Because this is an expensive commentary. Then go ahead and buy Klaus Vogel. It's really not required if you're beginning with the self-study of international taxation. If you're into hardcore international taxation advisory, if you're starting on that, again, you're welcome to come to my office and have a look at Klaus Vogel. But you'll find, sincerely, I'm telling you, you'll find that unless you're into hardcore international tax advisory, you'll not get to use it a lot. And just for the sake of your knowledge building, this is a bit too much of an expenditure unless you're very confident you want to do that. It again contains a lot of decisions, etc. But you'll find it's mostly centered on the German approach, of course, because the author being one. This is again one of those expensive, commentaries. It is written by Professor Philip Baker. It's in a very unique format. It's a loose leaf format. What therefore happens is whenever the publishers feel, whether the authors feel that the commentaries, a particular part of the commentary has undergone so much of change that the part which is with you is no more correct, then they might send you a revised version of that page, and you'll be given instructions on how to substitute that new page against the old page. Fantastic thing, right? So this is a loose leaf format, again an expensive commentary. This is Arvid Skar. This is actually the classic authority on permanent establishment. Again, a German gentleman who has undertaken a very unique approach towards the concept of permanent establishment. Again, if you want to have a look at it, I think I've seen this in the ICAI's library as well. But again, a lot of it is very dated in the sense that a lot of what has flown on the bridge about the concept of permanent establishment, while it is a beautiful commentary, the concept of permanent establishment has evolved significantly. Now we have concepts such as virtual service fee, for which we have decisions such as ABBF said. Very recently we saw how even Nicolas Cage was not even spared in the case of Volkswagen. So the point that I'm trying to make is it's a classical commentary and a lot of time classics are beautiful to look at, but they are not necessarily connected to the recent times. So if you are very interested in understanding the theory and the philosophy, be my guest. Otherwise, don't spend on it. If you really want to look at the philosophy of international taxation, a beautiful book, 2 volumes commentary, is written by the gentleman, Mr. Roy Rohatgi, very learned, gifted gentleman actually. And he has given the interpretation not from an Indian perspective, but from a global perspective on why things have evolved in the manner in which they have evolved. So it is something which is specific for tax nerds, and otherwise don't go for it. This is by an Indian author, a very knowledgeable gentleman. He has written commentary first on permanent establishment standalone, and then in general on taxation of cross-border transactions. Both these commentaries are full of references to Indian laws, Indian case laws, and therefore are very relevant if you are again looking at something from a purely India-centric perspective. This was all about how to sort of build up your knowledge based upon the past fundamentals, the foundation. But don't just look at the foundation, because a lot of developments are happening on international taxation. That's why it is such an amazing field. The developments which are happening in the front of international taxation are such that we are literally galloping to just keep up with them. How do you stay updated? That's the second challenge. In any knowledge base building, you have to build up the existing knowledge base, and then you have to stay updated, stay aware of the changes which are happening now. How do you do that? Again, not something which is so difficult if you just get disciplined about it. Firstly, just to be able to identify that what are the new developments which have happened, and how relevant they are really. Do you really need to go through the 80-page long pillar one approach document given by OECD, or are you probably something you can take it up for couple of Sundays down the line? You can do a very simple thing: subscribe for tax alert by any good professional firm, by any good chambers of commerce, chambers of tax, any good associations which are active in tax. There are a good number of professionals and professional services organizations which are preparing some very good tax alerts, and these tax alerts contain summarized version of the latest development. They can be case laws from an Indian perspective. They can be case laws which are so important. While they are of case law of another country, they're still so important that tax alert has been prepared in India about it. They could be reports being issued by OECD. They could be toolkits which are issued by multi-agencies, OECD, IMF, World Bank, UN, coming together and publishing a toolkit. And actually, this is something which happened in case of offshore indirect transfer. The 4 leading agencies of the world, they came together and published a joint toolkit on how do you deal with offshore indirect transfer, the Vodafone kind of situation. And they actually refer to the Vodafone situation there. They refer to the case law Vodafone. So these are the kind of things that you can do for at least identifying what's the development, and to be able to get a very brief summary, a bird's eye view of what that development is. If you are not in too much of a hurry, that is probably the starting point. If you are the one who loves to be updated about the recent development at the same point of time as rest of the experts in the field are updated, then you can actually subscribe for any good tax database. It could be an Indian tax database, and there are some good number of people who are working in this field. Taxman, Tax Sutra, Tax India Online. I'm not getting any remuneration for mentioning these names from any of these. I'm open to that, but therefore you can opt for the one that you find most user friendly. Of course, each of these have their different price points, but you can subscribe to them if and only if you think that you want to hear the latest news first. But otherwise, most of the developments which are happening are freely available online. Just that I hope if you're not in too much of a hurry. What you can also do is to keep yourself connected, to be sure that you are interpreting these developments in the right sense and the right manner. Why don't you actually participate in sessions which are organized by the regulatory bodies such as the ICAI, the professional bodies and associations and chambers such as CA Sansaar and the likes. So be a part of these sessions and listen to what the other experts are talking about these developments. Try, and if possible, once you have identified that a particular development is relevant, is something which you find very interesting and potentially of use to you, then try and go back to the source document. If it's an OECD report, read the OECD report. Don't just stop at reading the alert. If it's an Indian decision, try and read the Indian decision, and don't just read its catch note and head note at the top of it. There are a good number of publications or articles that you find, which are published by a lot of online service providers. Read through that. At times you will also find, and that is a bit of an exception, but at times you will also find that some of these, they combine the articles written by experts on latest development, and they publish a compendium. So it is not an article wise compendium, article 1 2 3 4. No, it's not a section wise compendium. It's just a compendium of articles written on recent developments, recent controversies, and these articles are written by experts in this in the arena of international taxation. Just to give an illustration, one of the examples is this one. So you can, it's a 4-volume compendium on international taxation. It's not arranged as article 1 2 3 4. Instead, what it has done is that it has picked up one particular controversy and written a couple of articles, and got a couple of articles written by a couple of experts, and placed them there, and then they moved on to another controversy. Another very interesting format. I think that is where I draw to the end of my discussion here. The thumb rule is
Few queries are there.
yeah, I will be taking up the query, sir.
Yes.
The thumb rule is that so long as you are spending, and I know this is a research which has been actually refuted, but yet it's probably not a bad idea that if you have spent 10,000 hours or more on something, you will find yourself now being counted as an expert in that field. So let's start counting your 10,000 hours.